Right now, retail investors are going all in on stocks buying the war dip. But who are the ones telling us to buy the dip? The big banks, while they're allegedly dumping. My name's Nick. I've been a professional investor and unprofessional trader for 24 years. Today, we need to talk about why smart money is quietly fleeing the market while retail is left holding the bag. Let's figure this out together. But before we start, I'm not a financial advisor. This is not an inducement to buy or sell any assets. And most importantly, do not take financial advice from some random dude on YouTube. I'm just presenting you with some facts here today. So let's get into it. So if you look at Twitter or turn on financial news, the narrative is fairly unified. They tell you that the recent market panic over the war in the Middle East is just a temporary shakeout. They say the dip is a gift, so retail believes it. And retail isn't just buying with their own cash. They are loading up with a terrifying amount of borrowed money, leverage. US margin debt just hit its 7th consecutive record high at 1.23 trillion. That means that US traders are using over 1 trillion of borrowed money to trade. On top of that, investors have piled in another 250 billion into leveraged ETFs. They are absolutely addicted to leverage right now. Just look at what happened in South Korea a few days ago. When the Kospi crashed more than 7% on the war news, Korean retail investors bought 462 billion of leveraged ETFs in a single day. That is the largest amount ever recorded. They are catching falling knives with borrowed money. But why are they doing this? Because the biggest banks in the world are publicly telling them to. Goldman Sachs just released a note telling clients to view any correction as a buying opportunity with relatively low risk. When a bank tells you something's low risk, they push out this narrative so you feel safe putting your money on the line. But here's the bigger problem. The public message and what the smart money is actually doing behind the scenes are two completely different things. And that's exactly why I use Ground News, who are sponsoring today's video. When the banks and media outlets push you a unified narrative, you need to see the full picture to avoid getting trapped. Ground News lets you see the bias, factuality, and ownership breakdown of every financial story, so you know exactly who is trying to influence your trades. You can get 40% off their Vantage plan by going to ground.news/NickFinance or using the code NickFinance at checkout. It's an essential tool for cutting through the noise. So let's talk about exactly what the smart money is doing while you buy the dip. And this really comes down to the anatomy of distribution. Over the last 5 trading days, the S&P 500 ETF, SPY, saw 11 billion in net outflows. So while retail is using record margin to buy, 11 billion of institutional capital just quietly walked out the back door. So the truth is right there in the data. Institutions are distributing their risk onto your balance sheet. But why are they so desperate to exit right now? Because the underlying math of the market is not looking good. The cyclical adjusted price to earnings ratio, or the CAPE ratio, I'll explain what that means in a second, just hit 39. Historically, the average is 17.3. The only time in the 155-year history of the stock market that we've been higher than this was the dot-com bubble in 2000 when it hit 44. And in 1929, right before the Great Depression, the CAPE ratio peaked at around about 32.5. So we're sitting at 39 while fighting a war in the Middle East, with oil testing $120 a barrel yesterday, although it did drop, of course. The disconnect from reality is just staggering. In case you don't know, by the way, what a CAPE ratio is, it compares today's stock prices to the average earnings over the past 10 years adjusted for inflation. A CAPE of 39 means investors are paying $39 for every $1 of average inflation adjusted earnings from the past decade. So in plain English, it signals that the market is extremely expensive by historical standards, sitting in the same zone as the dot-com bubble or just before the Great Depression, right? And all you need to do is look at the University of Michigan Consumer Sentiment Index, which is currently sitting at 56.4. That is roughly 30% below its historical average and perfectly in line with the lows of the 2008 financial crisis. So consumer sentiment is, they think things aren't good, right? But here's the craziest part of that data. Sentiment actually went up for people who own large stock portfolios, while it crashed for people who don't. The market isn't reflecting the real economy anymore. It's just reflecting the psychology of leveraged investors who need it to keep going up. So who is actually setting this trap? Well, it's the exact same institutions telling you everything is fine. Goldman Sachs tells you to buy the dip, but their own chairman, David Solomon, publicly admitted he's surprised by how benign the markets are acting. Meanwhile, JP Morgan's internal trading desk is screaming caution, right? So JP Morgan is waiting, but they are perfectly happy to tell you to buy the dip when it's, their retail reports that they're releasing, allegedly. This is how institutional distribution works. They cannot just hit the sell button on billions of dollars of assets without crashing the price and ruining their own profits. They need counterparties. They need someone to buy as they sell. They need you. They engineer euphoric buying through media narratives so they have enough liquidity to fill their massive sell orders, allegedly. So they prop up price just long enough to transfer the toxic risk onto retail traders, again, allegedly. And I say allegedly because, Wall Street banks would never intentionally manipulate retail investors to say themselves. I mean, they've never done that, right? Like, in 2008. Anyway, so when the buying finally dries up and retail is maxed out on margin debt, the support just vanishes. The floor falls out, and the brokers that gave you that 1.2 trillion in margin debt, they're going to force liquidate your account to protect themselves. So now your money is their money. Congratulations, as it always is. That's why I always say to be careful with leverage. This could be one of the biggest leverage traps in the existence of markets, and the banks may be about to fleece retail for billions. If you want to see another massive trick being pulled by banks and Wall Street, check out my main channel video from yesterday. They were after your pension next, and you need to protect yourself. I'll see you in the next one.